So we are the team at John Deere, and we are putting together an audit planning memo. And my name is James.
My name's Christina.
And David.
Okay, so just to give you a little bit of background information on John Deere. John Deere, it was founded originally in 1837, and the man, John Deere, he was actually a blacksmith and inventor who used his skills to create products that would basically streamline agricultural processes. And it initially started with steel plows, and over time it turned into some of the most advanced machinery on the market, which includes tractors, harvesters, their famous riding lawnmowers, and other outdoor power systems. They're currently being led by their CEO, Samuel Allen, and some of their actual divisions within John Deere include agriculture, construction, forestry, turf, and power systems. And over time, John Deere has expanded outside of the United States and is considered one of the largest global brands to date. With our client acceptance, we actually, before we accept our client, we had a few procedures that we followed, and this included inquiring the management for any sort of fraud or misappropriations or any sort of incentives to cause fraud, and based off of that, they came out clean, nothing out of the ordinary. They presented us with all their financial statements, so there were no scope limitations. And we then inquired their legal team of any sort of contingent liabilities or any sort of big legal factors. And things that came up were product liability, retail credit, software licensing, and anything that they basically do throughout their ordinary nature of their business. And based off of that and their legal team, we can see that there's nothing that could cause a material effect on the financial statements. Based off of that, we can see that there's nothing that really stands out to us, and John Deere is going to be limited risk to us as a client. Some of the risk factors that we found on John Deere's 10K include different types of outside regulatory fiscal policies that could possibly affect our ability to acquire raw materials or even affect the exchange rates that we have in foreign countries. Different government policies could affect our tax rates, and that could negatively affect some of our operations in the forestry segment because that segment already has high taxes. Bioenergy could be an impact on us. That has to do with the different emission standards that are being implemented now. So we would have to put in R&D in order to change our engines in order to comply with a lot of the emission standards. Poor and unusual weather conditions is also pretty big for John Deere, because if we have any sort of droughts throughout the world, that could cause people to not farm and cultivate crops. And strict environmental health and safety laws, that would be something to worry about too, because we have a lot of employees who work in our manufacturing plants, and we want to make sure that they're operating in safe conditions, and we're complying with all regulatory standards to make sure that we don't risk having any sort of huge litigation issues. Next, we can look at our proposed materiality for John Deere, and we initially looked at revenues, but we switched over to total assets due to the fact that our revenues really fluctuated this year compared to our prior years, and it decreased significantly. So we chose total assets because it was pretty steady across the past few years, and our actual assets for this year, our total assets are $25.3 billion, and we used applied 1% of materiality to that, which gives us an overall materiality of $253 million. And basically, as long as all of our accounts do not exceed $253 million, then we will not be, as long as nothing exceeds that materiality threshold, then we can offer them or we can give out an unqualified opinion.
Prior to our actual audit, we started off from flux analysis of financial statement and comparing analysis, estimate, and opinion for the prior year performance. The companies we looked at net income and earning per share first time, and their revenue account decreased by 28% and net income decreased by 21%. And earning per share went down by $3, which was more than 30%. Analysts are expecting the company's revenue will go down even more, about 10%, and earning per share may go down about $1 per share. There may be risks that management over-apply the revenue account or under-apply expense in order to achieve shareholders' expectations. However, the biggest competitors, Caterpillar, revenue and net income went down by 40% and earning per share went down even more than Deere and Company. So we believe that 2015 was very unfavorable for the market as a whole, not only just Deere and Company.
So one of the audit procedures that we would like to conduct and implement is looking over John Deere's revenue recognition system to make sure that they're actually billing the proper customers and actually receiving maybe the proper amount of revenue, cash, and making sure that they're not actually overinflating any of their revenue that is listed on their income statement.
So next big account that we looked at was asset. Per company's underperforming result in 2015, we assumed that the asset would go down accordingly. Surprisingly, it did go up, and cash account actually went up by $400 million, which was very unusual that we think. So there may be high risk that cash account is actually exist as what the management asserts. So for the audit procedure, we want to confirm with the bank that their cash is actually existed. And next big account that we looked at was debt. Their debt, the company actually paid off more debt than ever before. So it was really unusual changes that we think. So there may be high risk that management actually had paid their debt.
And some of the audit procedures that we would use to assess the debt is, first we want to check to make sure that the accounts exist. In order to do that, we would obtain paperwork showing that the business committed these obligations, as well as making sure that the accounts are included on the financial statements and that their amounts are correctly recorded.
So next thing that we looked at was depreciation. So company's total asset, the depreciable asset took 30% of the company's total assets. So we assume that this account is really big to audit. So however, we looked at the trend analysis of depreciation expense, and it was pretty consistent throughout the prior years. So we put medium risk of the management, and we want to verify that management is using proper method for depreciation and proper useful life of the asset. And we also looked at cash flow from operation. Their cash flow from operation actually went up by 20%, and it was pretty unusual. changes. And there, I mean, even with the profit margin went down by like 2%, 7% from 9%. So it was very unusual. So we put the risk high risk in cash flow, and we want to verify their expense account was actually existed. And next big thing that we looked at was Deere and Company's stock price. Analysts estimate that Deere and Company's stock price will go up to $90, and per historical data, there is a trend that the company's stock price goes up to $95 in spring and summer seasons, and it goes down by $20, $70 per share in fall and winter season. So we put high risk that management is trying to hit the analyst estimate.
So for just a couple of general risk mitigating factors that we noticed were their internal audit function and their unqualified audit opinions. John Deere has a really good internal audit function, and so we took them into consideration while planning our audit memo, as well as taking into consideration their unqualified audit opinions since they've gone public. Some potential material weaknesses we noticed while doing our assessment are some changes in the accounting standards. In the near future, in 2019, we're coming up with some new accounting standards that could have material effect on the financial statements. There were 3 that we noticed. For revenue recognition, a new standard is going to be implemented in 2019, and this new standard requires disclosure about the nature, amount, timing, and uncertainty of revenue from customer contracts. This could potentially have an effect on the financial statements, as well as recognition of financial instruments, which will be ineffective in 2019 as well. Another standard that the FASB is releasing is the standard for leases, and this will cause requirement for entities to recognize a lease liability. Some accounts that we noticed would be difficult to audit were our total inventory, because John Deere has multiple warehouses, and to audit just one warehouse may not be representative of the company as a whole, as well as some pension plans and post-retirement health care and life insurance plans. The plans fluctuate between 30 and 60 million between 2015 and 2016, and this would be hard to audit the amounts because they vary so much. The last thing that we noticed would be difficult to audit were the values of goodwill, the true value of it. It's hard to obtain fair market value information pertaining to particularly acquired entities. So this would be another account that would be difficult for us to audit.
So wrapping things up, this is our audit planning memo for John Deere, and we've kind of outlined the background and key financial risk factors that pertain to John Deere.